Today, there are more than 7,000 mutual funds in the US alone, and therefore this is a highly irrelevant question for us investors. How can we tell whether this manager is truly skillful or just lucky? Obviously, everybody wants to invest with the truly skillful manager rather than a lucky monkey. And here, I will need to introduce a few statistical terms. When we assess the skill of a manager, usually we refer to a term called active return, which is the difference of the manager's return over a selected benchmark, such as S&P 500 index. The reason is obvious. If the manager fails to beat, for example, S&P 500, there's no reason for us investors to invest with him because we can easily get S&P 500 by buying a S&P 500 ETF or index fund at a much lower cost. And there's another term called volatility, which is the standard deviation of the active return that the manager delivered. So if you divide the active return over the volatility, you get a term called information ratio. Now, in the US, if the manager delivers the investor a IR of about 0.3, he is pretty a good manager. And if the manager delivers an IR of 0.5 and above, he will be categorized in the top bracket, probably top 10% of the whole mutual fund cohort. And I apologize if I have to constantly introduce new statistical terms, but I promise you this is the last one. The T-statistics. The T-statistics is the product of the information ratio and the square root of the number of observations. Now let's ask ourselves this question. How many years of observation do I need to observe before I am sure that this manager is truly skillful rather than just lucky, assuming that the manager is excellent, delivering an information ratio of 0.5? The answer is that based on 95% confidence level, the T-statistic accordingly is about 1.96. And based on an information ratio of 0.5, you need the N to be at least 16, which means that you need to observe a track record of 16 years of that manager to be 95% sure that he is truly skillful rather than lucky. And if the manager delivers you an information ratio of 0.3, the N will need to be 43, which means that you need to collect a observation of the real track record of the last 43 years before you can be 95% sure that he is really skillful. Now I hope this little exercise can help to explain why it is so difficult to pick a truly skillful manager in the reality. And this is probably one of the reasons why most investors did badly, according to a research from Dauba, a research lab in the US to analyze investor behaviors. Most investors in the US hold an equity fund or bond fund for about 3 years before they change to another one. And their return, whether you look at the last 1, 2, 3, 5, 10, or 20 years, always trail a very simple strategy of buying and holding a simple index such as S&P or a bond index.